Welcome to Barenaked Money, the podcast where we strip down the complex world of finance to its bare essentials, with your hosts, Josh Shellick and Colin White, portfolio managers with Barenaked Capital Management, Inc.
Welcome to the next episode of Barenaked Money. The OG, Colin, Josh coming at you. And this pod, we're going to talk about how dividend investing is for losers. Right, Josh?
Pretty much. I think that's it.
So we're going to do a little bit of a dive, and I could give some backstory. I mean, Josh probably doesn't even know this. What tweaked me in wanting to have this conversation was one of our team had a conversation with an advisor, another firm, who, when they found out that we did not offer a dividend sleeve or dividend-specific investing, that obviously we didn't know what we were doing, because that's where everybody should have their money, and therefore we didn't know what we were doing. And it rankled me a little bit. Rankled, I guess that's a good word. Would rankled be a good word for that, Josh?
Based off of how I know you, I think that's a fair comment. Yes.
Well, maybe Josh, why don't you take the side of light and the side of goodness? Why do people have such a fondness for dividends right out of the gate? Where does this love affair begin back in the annals of academic investing? Why is it seen as such a good thing?
So the academic parts, I'm going to put that aside for a second, but I'm going to answer
answer whatever question you want.
Yeah, I'm going to answer why do people see this in such a positive light, and I think it's because it is a very tangible and consistent and observable thing. It's easy to identify that this stock has a 5% dividend yield. Dividends are fairly consistent. I'm going to get 5% all the time. The market can go up, the market can go down. I'm getting my 5%. I'm getting paid every quarter. I'm happy with that. And it's easy to see and it's tangible. And I think that is why there's such an appeal of the dividend investing idea. It's an easy story. As an advisor, it would be very easy for me to convey to somebody, hey, your stock can go up and go down. You get your 5%. You should be happy every year. And I don't agree with that take, but it's very easy if I wanted to have a simple story for somebody as to why dividend investing is great, I could convey it very easily. And so I think it's all those things that have come to the forefront when this push for dividends is so appealing for some people.
Yeah, and I think one step further is people also see it as profit. They equate dividends with receiving profit. Therefore, I'll leave my capital invested and I'll keep taking the profit off of it in the form of a dividend. So there's a very direct correlation in mind. It's an oversimplification that's not true, but it is, hey, as you said, it's easy to say to somebody, it doesn't matter what the market does, you're going to get your money, and it's, you're just taking your profit off the table. Well, I'm just taking my profit and my capital's still there. I mean, there's a whole bunch of leaps there that are tragic, but that's the line of thought. Would that fill it out a little bit?
Yeah, I think that's fair for sure.
All right. So, and it's funny, I was reading a piece on the RBC website on their ETF dividend investing about how dividends lower portfolio risk. Do you think that's a statement that can be made carte blanche, Josh, without any caveats or explainers? That you could just say dividends are less risky?
No, that's definitely not true. Even in a theoretical or academic sense, it's not true. I think what is true is maybe a derivative of that, in that more mature businesses tend to pay higher dividends. So dividend paying companies may be more stable than non-dividend paying companies. And I think if you look at things that way, and if you don't control for any of the external factors, then I think that could be a true statement.
Or, as I would say, depending on how you squint and hold your tongue, yeah, maybe that's true.
Yeah.
But yeah, you're right. Older, more mature companies, but there's also, I don't want to jump around too much. I want to try to keep this in some kind of a story. But dividend stocks do tend to be way more interest rate sensitive than other parts of the market. They tend to move. Because again, and I've seen it happen, and I've had clients tell me it happened. They walk into the bank and they're looking at a 4% GIC, and the advisor says, well, I can get you a 5% dividend. That's better.
Yeah.
So people get diverted from a 4% GIC into a 5% dividend paying something or other. Yeah, there's just so much wrong with that on every possible level, but that does happen. So money does flow back and forth into the dividend-paying stocks and or dividend-paying product, depending on how attractive interest rates are. So I think in periods of interest rate volatility, there might be more volatility in something that is a high dividend-paying stock. Do you think that would hold up if we went back and looked at it?
Maybe. I'm not convinced on that. I think what this kind of gets at is that dividend paying stocks tend to be concentrated in certain sectors of the market. And you can say some of those sectors, like utilities, which tend to be high dividend payers, and real estate, for example, REITs especially, are definitely more interest rate sensitive. And sort of in an inverse way. So higher interest rates are probably going to be more negative for those companies. They tend to be more yield focused investments, and they tend to carry a lot of debt. So higher interest rates are necessarily negative for them. When you look at like banks, for example, which tend to be a little bit higher dividend payers in Canada as well, I think the sensitivity to interest rates breaks down a little bit. There's definitely some sensitivity there. I don't think it's necessarily the same obvious inverse relationship that you'd get from some other sectors. So I think there's some truth to what you're saying, but I think it's more related to the sectors that those dividend paying companies are concentrated in, rather than a function of dividend paying companies themselves necessarily being sensitive to interest rates.
If we had stopped this podcast with, don't worry about the markets, we're just going to pay you a good dividend on your money and your capital will still be there, people probably would have been happier with us.
But we would be very disappointed in ourselves, Colin, and that matters a whole lot.
Yeah. So, and again, just to go back on the history a little bit, to kind of go back and forth, dividends ostensibly are when a company has money that they've earned that they cannot invest back into the business and earn money on it, like almost too much money. Now, what you hope is management of a firm would take earnings and take a look at opportunities to reinvest them back into the business at a hurdle rate, meaning that they're going to get a return on it above a certain mark. And if they don't get that return, they would then choose to return the money to the shareholders so that they could reallocate it into the economic engine. And if it works that way, then that's the most efficient from a capitalism perspective. Company can't use the money above a certain hurdle rate, give it back to the investors, let them go choose where they're going to put it, and they'll reallocate the capital into something that's good. But it's kind of morphed beyond that, and if it ever was that, I'm talking theoretically only, but I know in the last 10, 15, 20 years, it has gotten way away from that. And now we're looking at, when somebody is paying a dividend, well, what's your payout ratio? And sometimes they're paying out more than what they're earning, or sometimes they're paying out less. Sometimes they're paying out way more than they're earning, which means they're borrowing money to pay out to the shareholders in some odd way, trying to support their share price by paying out dividends. And they've done some kind of mental gymnastics. Either it's the corporate compensation package or the cost of borrowing is such that it makes sense. But it's gotten pretty murky in the last, 5, 10, 15, 20 years. Well, let's take your time horizon, Josh. Since you've been involved, have you noticed any movement in how dividends, air quotes, are used?
Not really. I think it's been so I think capital allocation is changing somewhat, maybe in a slightly different way than you're describing. But I think that tendency. So maybe I can just paraphrase what you're saying, what I think you're saying,
Sure.
And that's that companies are now very focused on maintaining their dividend, because it has direct implications for how the market views their stock. And companies may be willing to continue a dividend when it doesn't make the most sense. It's not maybe optimal for their business. And I think that that's true. Is that kind of what you're saying?
Yep.
Yeah. And I don't know that that's changed since I've been around. I haven't been around long enough maybe to see it change, right? To see it evolve the way that you're describing. But I think one thing that has changed, especially in the US, is that companies are moving away from dividends in favor of share buybacks, which is just a different way of returning capital, and maybe a more intelligent way of returning capital to shareholders, because it doesn't have to be the same percentage or same amount every quarter like a dividend does. And it gives the company a little bit more flexibility to adjust to changing market dynamics, which is how a company should operate, quite frankly.
Well, and it is something that can be prone to manipulation in the right circumstances, because you do have corporate compensation packages that have shares involved in them and stuff. So there can be, in some situations, motivation at the table to manipulate the dividends in such a way to support corporate compensation over any particular goals of the company or goals of the shareholder as well. Because it is something that can be gained. Like you can play with dividends and you can have an effect with it. And anything that can be gained will be gained. And it depends on what the motivations of the people are involved. So that's where it gets murky. That's where I get really, I don't believe that it's a simple thing. Hey, I'll just give you the money. Don't worry about the market. She'll give me your profits. I'll leave my capital there. That math doesn't fly. There's way more under the hood than that, for sure.
Yeah. So let me, taking that first question that you asked about why do people do this, let me throw one back at you, which I think is, it's on a simple level, it's a reasonable argument, but I want you to poke some holes in it. So let's say I have $100,000 invested in whatever dividend paying company X, and the market's down. I don't want to sell my company. I don't want to sell when it's down, but I'm getting a dividend and I'm able to live off of the dividends that are paid to me. I think this is a big argument, right? I retire, I buy dividend paying stocks, I'm able to live off my dividends. Tell me why that does or doesn't make sense as an argument for dividend payers.
Well, again, it's viewing that the dividends as being, something that can't change. That's part of it. We saw this with Algonquin here not that long ago. We picked an entry point after a dividend cut. And Algonquin was one of the utility companies that was paying a very stable dividend for a long period of time. And all of a sudden you wake up one day and it goes away. And I think there's an overconfidence in dividends. And there's a lot of blue chip companies that pay dividends. Nortel was a blue chip company. And again, these are the extremes. These are the odd things out there, but they happen always. Like there's always surprises in that space. So to think that, I'm in retirement, all my money is tied up in the stock and I'm going to live off the dividend is really risky. There's an article in the Globe I was reading today, Rod Carrick put out, talking about how these beat up dividend stocks, are back in favor now because GIC rates have dropped below 5% and more money is flowing into them. I just grabbed a couple like TransCanada Pipe. I mean, the price, the drawdown, I think it was $75 to $50. It was, one of the larger drawdowns, right? So if I'm in retirement and situation changes and my money just drew down, the capital that you think you just left there has dropped by 30%. That's a big deal. That takes away a lot of options for adjusting to things as they happen. And I think you're putting way too much confidence in a dividend payment to think that it's reliable as all of your retirement income, because again, there's too much volatility in the underlying, and you can go through and take a look at any of those dividend paying stocks, and dividend paying stocks have actually underperformed a lot of periods in the last 10 years, and so you think you're getting ahead by doing that, you're actually taking yourself further behind, because if you're going with dividend paying stocks, you're going with a specific thing that has a specific set of attributes. And so therefore you're more fragile than if you're relying on a whole system that is stronger. It's that whole diversification thing that I'm talking about. The fallacy that your capital is there, air quotes, that doesn't hold. Your capital may or may not be there. Only there if the share price holds up. Yeah.
Yeah. And I think a lot of what you're getting at there is, like, we try to look at everything from a total return perspective, and however we get to that total return, it doesn't matter a whole lot. Like I would say almost unequivocally, I would rather have a 5% capital gain than a 4% dividend. And if you want to argue with me about that, feel free to come on the podcast. I'm sure we'll have a good discussion. But that's kind of where that's how we try to look at it. It's like, it's not like it's not that we think dividend investors are losers, or that it's for losers, or that they suck, or anything like that. It's that it's just one component of a return. And as an investor, we should be somewhat ambivalent between capital gains, dividends, or interest, taxes aside for the time being. And then coming back to the idea, well, if I don't have to sell when the market's down, I can just let my, let things run and recover. That's noble. That's great. But think of it this way. If you have $100,000 invested in a company and they pay you a $5,000 dividend, that's taking $5,000 out of your investment. Like, that investment is now worth $95,000. So it'd be the exact same thing, practically speaking, as taking that $100,000 investment and selling $5,000 and putting it in your pocket and going to spend it. So there's a bit of a disconnect between what a dividend actually is for somebody. It's taking capital out of a stock-based investment and going to do other things with it.
And just to bunny trail off for a second, this is something else that's floated out there, because there is slightly preferable treatment to Canadian dividends, for a Canadian shareholder. So there are those who believe Canadian dividends are the only thing. Now you've really gone further down the bunny hole, and you have concentrated your portfolio even further from a geographic perspective. And if you do the math on what that does to the risk profile of your portfolio, it's not positive. It doesn't make it less volatile for doing that. But again, it's one of those really easy to say, really easy to implement. Hey, doesn't matter what the market does, I'm going to give you tax effective dividend income out of your portfolio. Wow, tax effective? My capital's still there and I'm getting paid? Oh my God, where do I sign up? And that's where the logic stops. And you end up with somebody who's got a disproportionate amount of, I've seen clients with 100%, or prospects, no clients, 100% of their money tied up in Canadian dividend paying stocks. That's my father-in-law used to say, the difference between scratching your ass and tearing it to pieces. Canadian dividend paying stocks can be part of your portfolio for sure, but to think that that's the be all and end all, you are absolutely increasing the risk profile of your account. There's no mathematical way otherwise. But people love saving tax. Hey, you're going to save tax. Oh my God. And they stop listening. They really don't care what comes after that. It's the easiest way to get somebody to do something until it gets well overused.
Right. Yeah. And you know what else helps you save tax is deferred capital gains.
I know, right?
Can you believe it?
Tax advantage, capital gains are tax advantage too, right?
Yeah, that's right. Your stock can go up in value and you don't have to sell it and you don't have to pay tax at all. Holy, I think we just stumbled onto something here, Colin.
Quick, let's book a roadshow, go across the country and tell everybody how wonderful this is.
Yeah. Well, so you mentioned there hasn't been a consistent track record of dividend strategies outperforming, and I actually looked at a bunch of different markets, a bunch of different strategies, a bunch of different indices just to see how it holds up, because you'd think that at some point people would start poking holes in this dividend strategy and looking at the actual track record of it and saying, wait, maybe this isn't so awesome. But that hasn't really happened. But anyway, so I looked at a bunch of different indices around the world, and I looked at the last 15 years. And so I looked at Europe. In Europe, a dividend strategy has underperformed a broad index, a broad benchmark. And I tried, by the way, so I looked at our database. There's 646 dividend indexes in our database. So I'm sure somebody out there is going to argue with me about the indexes that I chose, but I tried to choose very general, generic dividend indexes so I could get the pure dividend index versus just the broadest benchmark that I could in that same market. So Europe, dividends underperformed over 15 years. In the US, dividends underperformed for the last 15 years. In global markets, dividends have underperformed. In emerging markets, dividends have underperformed. In Canada, dividends have slightly outperformed over a 15-year period. And internationally, dividends have outperformed over a 15-year period, but not over a 10-year period. And just to provide something that's a little bit more tangible for somebody, I looked at some BMO ETFs. I looked at the BMO S&P TSX Composite ETF versus the BMO Canadian Dividend ETF. The TSX Composite ETF has outperformed by 1.5% per year over the last 10 years. And I looked at the US market as well, the S&P 500 ETF from BMO versus the US dividend paying ETF from BMO. And the S&P 500 has outperformed by 3.5% over the last 10 years. So at best, dividend investing has a spotty track record of outperforming. And at worst, you could say that broadly speaking, it hasn't outperformed. It's actually underperformed, and in some markets, quite substantially over the last 10 to 15 years.
Well, the beautiful thing about how we position this argument is that makes us the winner, because we're starting from the premise that it's always the best, and that's how many people treat it. And by proving that it's not always the best, we win. We don't need to prove it's always the worst. I mean, that's too high a bar. We're not going that far.
We set a low bar for ourselves for sure.
Exactly. So I want us to disavow people of the idea that this is a simple solution. And people love simple solutions. They really do. Right.
We love simple solutions. People should love simple solutions, but what I think we're trying to say is this is not a solution, or you think it's a solution and it's not actually not.
Looking for love in all the wrong places. Yes, the simple solution is always the best solution, but it has to be a solution. Just because it's simple doesn't make it a solution. Simple solutions are best, but not all simple things are solutions.
Right. Yeah. 2 + 2 = 5 is simple, but it's not right.
Yeah. No, absolutely. No, I think that it's, and I guess let's trail off a little bit. I don't know if you put this in your 3 bullet points for this pod, but what the industry has done with manufactured product and dividends versus distributions and how that's been gained. Because that's something that the industry, because this is so convincing, dividends are great, your capital just sits there and we're going to pay you a dividend. The financial industry has bought into that, and now you have lots of products out there that'll pay you a fixed distribution that they call a dividend. And oftentimes that distribution that they call a dividend is return of capital, meaning they're giving you your own money back. So, you'll invest in something and they'll say, well, this has got a 12% dividend. Oh my God, a 12% dividend? It makes 12%? That's great. And everybody's happy until you realize that it's eating away at your adjusted cost base. It's not growing by 12%. So your capital is eroding. And when you sell at a loss, you actually still have a capital gain. And you're going to have, somebody's going to have to call me and I'll explain how that works. But in those products, and we've just seen it very recently with a prospect, you can sell at a loss, like have lost money, and still end up with a capital gain you got to pay because of the erosion of the cost base. So dividend and distribution get used interchangeably, and I've attended presentations where I've corrected the presenter who refused to be corrected, because a distribution is way different than a dividend in a practical sense, and often has a return of capital. And those can be ETFs, they can be mutual funds, they can be any kind of product out there. They put a fixed distribution or dividend on them, specifically aimed at the retirement group, and say, this has got an 8% dividend. Oh my God, that's way better than my bank stock. And that's all. Everybody stops talking at that moment, and the client goes into the product and wakes up 10 years later and wonders how they got there.
Yeah. And a lot of times they'll just use the term yield. You have an 8% yield on this product. Okay, well, what does that mean? Yeah. Does that mean that it's actually earning 8%, or does that mean that you're just taking my initial pool of capital and giving me 8% of it back every year? Because those are two very different things. And it has muddied the water. And I think there's valid reasons for trying to keep things consistent in terms of distributions. But I think the more cynical side of me says that it's been used to a marketing effect, and it's a bit of a veiled consistency that's not necessarily there for people.
Well, absolutely. I mean, because you are cashing out units. I mean, again, the way we handle, paying money out to a client is we use a cash rate. So we'll stick money in a high interest savings account for a period of time. And that's where your money comes from, rather than cashing out investment accounting, on distribution accounting, on any of these other mechanisms that are put in place, because those are all artificial. And they all have holes in them. So we just want to see the account grow. We're agnostic to how it grows. We'll take interest if it comes. We'll take dividends. We'll take capital gains. Fantastic. We'll take all of that. And we'll just convert that into something that's more secure for paying out to a client. It's more complicated. Vastly more complicated to do it that way. You have to meet with your clients regularly. oh my God, you have to review, their needs for cash and make an allocation. And, you can't just cash their check, work Tuesday to Thursday and only take phone calls between 10 and 2. You actually have to put an effort in. Sorry, now I'm ranting.
So is one point there where I think something with a distribution makes sense. And that's if you are somebody who exists in a world with transaction costs. So if you are paying a commission for every sell that you have on a monthly basis, then you can kind of talk me into, I need the dividend so I don't have to pay to sell my stock every month to get the cash flow that I need. I still think transaction costs are so small now. They've been whittled down to such a small amount of the overall pie, most likely, that argument doesn't really hold up anymore. It might have held up 30 years ago when you're paying $250 for a stock trade, but now you can find a lot of platforms where it's actually literally free to do a stock trade. So, or an ETF trade or something. So I don't know that argument is still valid.
Well, I'll push back on that a little bit because, again, I don't think that it's a great strategy to be selling something in the market every month to live on. You should be doing that. You should be doing that in lumpy, like, once a year, once every 18 months, topping up a savings account, living off that.
So not selling stocks. Selling stocks on a monthly basis is probably not where you want to go, right?
Yeah. But again, for me, it's any market exposed to anything that's got volatility to it, because, again, month over month, you can see volatility. Mm-hmm. And picking a good month and setting aside a year's worth of income, then that's managing risk. That's making sure that you're not exposing yourself to the next big apocalyptic pandemic, locust swarm, earthquake, volcano, Trump's president again situation. But it's a different way of managing risk. Now, those would argue against me, saying, well, my money's out of the market. Well, yeah, your short-term money shouldn't be in the market. Mm-hmm. You want to keep your short-term money short-term, because the things are just, you can't tell what's going to happen next.
Yeah. So you mentioned academic research before and what that suggests about dividends. And this is one thing where, again, it pushes back, it refutes anybody that's out there really, really promoting dividends, because there's academic research that shows all kinds of things, all kinds of different factors or attributes of companies, helps those companies get better performance. And some of it's valid, some of it is maybe not, some of it's a little bit hard to swallow. There's some issues with some of that research, but consistently, dividend yield does not show up as something academically through research, peer-reviewed research, as something that would add value over time. There's just not a lot of evidence that suggests that. So even if you discount the actual results that we were talking about over the last 10 to 15 years, academically going back decades, there's not a lot of support to the idea that dividends are going to help you outperform.
Gosh, if I put my capital in and it's going to pay me 5%, I don't have to worry about the market. That's good, right?
Sounds good on the surface. I think we've done enough to refute that by now, hopefully. Rewind a minute two and listen again if you have to ask that question.
No, again, it's unfortunate, but it's complicated. And any effort to ignore the complication, you do at your own peril, because there's some very material things. And again, the Canadian dividend paying space, especially if you go into the utility sector, has seen some severe volatility in unit prices, and that matters. Do you want all of your retirement money tied up in something where you're not touching your capital, but your capital has dropped by 30%, even though you didn't touch it? Again, those kinds of things have gone on and can go on. And it's really, really a shame when you see that happen, and you really don't want to. I don't like seeing that happen. And that's why I got on the soapbox about this. I don't like people having displaced confidence, because, man, it hurts when you fall off. That really, really hurts. And that confidence is just not warranted. So please, please, please don't think dividends are, God's gift to anything. It's part of the money you want to make, but you really shouldn't rely on that as the sole metric that you're using.
Yeah, as we leave on so many of these podcasts, we remind people that diversification is super important and maybe the most important thing when investing. And almost by definition, dividend focused investing is reducing your diversification, sometimes to a significant extent. So if you take anything away from this conversation, maybe that's it.
And dividends are for losers. If you're breaking a sweat trying to figure out what your financial advisor is talking about, you're not getting the service you need. You probably hate trying to get an answer from them, but you also think moving your accounts will be a headache, and it might be. But working with don'trocktheboatwealthplanning.com or .ru isn't exactly stress-free, is it? Call us. We will demystify the world for you.
For more information on the subject of today's podcast or any other financial topic, please visit us online at verecan.com. That's verecan.com. There's plenty of information there, or you can reach out to someone on the team. Thanks for listening. Please note, the information provided in this podcast is for general information purposes only. It is not intended as financial, investment, legal, tax, accounting, or other professional advice. Our discussions are not a solicitation to buy or sell any securities or to make any specific investments. Any decisions, based on information contained in this podcast, are the sole responsibility of the listener. We strongly advise consulting with a professional financial advisor before making any financial decisions. Listeners should be aware that investing involves risks and that past performance is not indicative of future results. Barenaked Money is produced by Verecan Capital Management, Inc., a licensed portfolio management company in Canada. We operate under the regulatory framework established by the provincial securities commissions in the provinces within which we operate. The views expressed in the podcast are our own and do not necessarily reflect the official policy or position of any regulatory authority. Remember, at Verecan Capital Management, Inc., we focus on aligning our goals with yours, prioritizing integrity and transparency. For more information about us and our services, please visit our website. Thank you for listening, and let's continue to challenge the norms of the financial services industry together.